Welcome to Westminster College and the Center for Financial Wellness. This lesson is titled Cash Transactions. In this lesson, we will be using the balance sheet equation and introducing an expanded balance sheet equation to analyze some common business cash transactions. As we learned in our last lesson, while the balance sheet equation does focus primarily on the balance sheet, since the balance sheet relates to the other financial statements, by using it, we're actually able to understand the impact of transactions on pretty much all the financial statements. And this will provide us with a broader perspective of the impact of each transaction. So using this balance sheet equation, we'll be able to understand balance sheet, income statement, cash flow, and equity. We're going to concentrate on balance sheet and income statement in this lesson. Okay, in this lesson, you will be actively participating. So I need you to go find, open, and save the related Excel workbook, CFW Cash Transaction Exercises. It should be in Canvas. Please review the workbook and ensure that there are two worksheets. One lists the transactions that we'll analyze, and the second worksheet contains the balance sheet equation. Let me flip over to that for a minute. Here's the transactions. Here's the balance sheet equation, and you notice there's an addition to it. We will learn a little bit about this additional portion as we review some of our transactions. Okay, as we go through our transactions, we're going to go through several steps and answer some questions. First, we're going to analyze it, which means more or less we're just going to talk about what's happening within this transaction. Then we're going to determine what accounts are impacted. We're going to use our balance sheet equation accounts that are on that workbook. Remember that a list of accounts that a company uses will be unique to that company, although there's some accounts like cash that are common to all, but we're going to use the ones on our balance sheet equation. We'll then determine whether each account has increased or decreased. And we're going to enter the amounts in the appropriate accounts, denoting decreases as negative. Okay, finally, we'll review the balance sheet equation to ensure that the transaction has kept the balance sheet in balance. Assets equals claims. So let's do it. All right, our little company, Computer Services, Inc., for their first transaction, they started their company when they acquired $9,000 cash by issuing common stock. So to analyze this, it's pretty straightforward. They're just selling ownership rights and receiving in exchange for that cash. So let's go to our balance sheet equation to think about what accounts we would impact. So one of the assets we have is cash. So it said that they were exchanging the ownership rights for cash. So I think cash will be impacted. Ownership rights are denoted in the equity area of the claims, where we have common stock and retained earnings. And if you remember from our prior lesson, common stock is the account we use for denoting contributions from owners. So it sounds like we're going to use cash and common stock. All right, increase or decreasing. So they are asking for cash, so they're receiving the cash. So I'm going to put in $9,000 as the cash they're receiving as an increase. Likewise, the ownership rights are increasing by the $9,000. So I'm going to put that in as a positive 9,000. Our last question is our balance sheet equation in balance? Yes, our assets increased by 9,000 and our equity claims increased by 9,000. So we are in balance. Something I want to show you on this. Notice that total assets increased on this. Sometimes this kind of a transaction will be referred to as an asset source transaction, meaning that total assets increased. Okay, next transaction. Okay, CSI borrowed $5,000 from a bank by issuing a note payable. All right, so our analysis on this is pretty straightforward again. CSI is in need of some more capital, so they're going to get some cash, but this time they're going to an external entity, a bank, and getting a loan. So what accounts do we think will be impacted? Again, the receiving cash, so cash is going to be impacted. But this time the claims are external. If you remember, liabilities are the external claims. So if we look in our liabilities accounts, we have a loan, which is similar to just notes payable. So I think that's an appropriate account to use for this. All right, increasing or decreasing these accounts. So they're receiving $5,000 from the bank. So I'm going to put $5,000 as an increase to their cash. And likewise, they are increasing their liability to the bank by $5,000. So there we go. So both are increased. All right, one more time. Let's see, our balance sheet and balance. Yes, it is. The 5,000 equals the 5,000. And again, this is an asset source type transaction, but we're getting the assets from an external claim rather than an internal claim that we did from the last transaction. All right, let's see. Let's go to our next one. All right. CSI provided services to customers and received $9,800 cash for payment. Okay, woohoo! CSI is now finally participating in the operational activities that will help it generate wealth. So it's doing its business. Remember, what is considered typical operating activities will vary from company to company, but we'll just pretend perhaps CSI is fixing some computers or installing a network, something that's their operations. The bottom line is they're selling their time and their expertise and generating the wealth instead of asking the bank or owners to contribute. All right, let's go to our balance sheet equation. All right. So once again, CSI is increasing cash, but how are they doing it this time? It's not going to be external. They're actually creating this internally. So I'm going to go to equity because that's internal, right? Well, they're not asking their owners for contributions. They're actually earning it this time. If you remember right, retained earnings is the account we use when we denote wealth that's generated by the company. So for our analysis here, I'm going to say that they're going to increase their cash by the 9,800, and they're going to likewise increase the retained earnings by 9,800. Okay, so this is the first time where they've actually generated the wealth themselves with their business activities. All right, so if you remember, I'm going to go back to this. If you remember, from our previous lesson, retained earnings is the cumulative wealth the company has earned, right? Also, you got to remember that the income statement is the financial statement that focuses on operational activities. It's the one that shows the value of the wealth generated or the wealth used up by the company in the current period. So the bottom line on the income statement, net income, shows the current earnings. So in other words, retained earnings is really, really related to the income statement. So we're going to use this transaction to now analyze how the income statement is impacted. So we're going to ask a couple of questions when we go to the income statement. We're going to ask, is this a wealth generating, an operational wealth generating activity or a wealth consuming activity? If it's wealth generating, then it means we're going to put the activity in revenues. If it's wealth consuming, then we're going to put it in expense. The next thing we're going to ask is, how does it impact net income? And that is determined by whether it's a revenue or expense. If it's a revenue wealth generating activity, then it increases my net income because those are positively related. If it's an expense, it's inversely related to net income. So an increase in expense will cause a decrease to net income. All right. The last question we're going to ask, or we're going to look at, we're going to make sure that whatever the impact and the amount shown in net income is exactly the same impact and amount shown in retained earnings. When I say impact, I mean, is it an increase or a decrease? Okay, so for this transaction, they provided services that were valued at $9,800. So that is a wealth generating activity. So we said we would put it in revenue for wealth generating activities. Okay, we've got that. So if revenue went up, that means net income, because they're positively related, goes up also. And then our last question is net income having the same impact and the same amount as retained earnings? And the answer is yes. Okay, so what do we want to do this? Remember, the income statement is looking at the value of the activities we participate in, which is very different from the balance sheet. The balance sheet is the results of those activities. And it's the results of other activities that may not be on the income statement. For instance, borrowing money from the bank. So looking at both of these provides us with a little more full view of what's happening with the company. So now I can see that the company internally generated some wealth, woohoo, that caused the ownership claims to increase for the company. Okay, that's kind of a long one, but all right, let's go to our next one. Okay, CSI paid operating expenses of $5,900 in cash. Okay, so looks like now that CSI is in operations, it will not only produce wealth through operations, but it's also going to need to pay business expenses in order to stay in business. For example, a company may need to pay rent and utilities for advertising. These and other kinds of activities are necessary for business operations. Again, each company's specific expenses will be unique to that company, but some are, pretty typical, like rent or salaries. But what's common is that paying these expenses will use up the wealth that the company generated. Okay, that's an important aspect to understand. Okay, so accounts impacted. Let's look at our balance sheet equation. All right, so they're paying for operating expenses. So they're going to pay in cash, so cash is going to be impacted. And we said that they're going to, when they do this, the company's going to contract, it's going to get smaller, right? And they're going to actually be using up some of the wealth that they generated. Well, the wealth that they generated is denoted in the retained earnings account. So when we use up some of that wealth, we're likewise going to take it out of retained earnings. Okay, so for this particular transaction, we're going to decrease our cash because we're paying it out by $5,900, and we're going to decrease our retained earnings by the same amount, $5,900. Okay, we impacted our retained earnings, so we need to think about, is this an operational type activity that should be on my income statement? And it certainly is. Paying operational expenses like rent, etc., are things that we have to do to stay in business. So I need to think about and analyze how it impacted my income statement. All right, using up wealth, paying somebody for rent is a wealth consuming activity. So we're going to put this into expenses. Expenses are actually increasing. I'm increasing my expenses. All right, our next question was, well, what does that do to my net income? Remember that these were expenses and net income are inversely related. So that means if expenses went up, my net income went down. And finally, our last question to ourselves, is the impact and the amount on net income the same as it is for retained earnings? And it is. So we've analyzed this one correctly. Oh, we didn't ask if this balance sheet balanced, and it does. 5,900 in assets went down, 5,900 in equity went down. Okay, onward. Okay, next one, CSI paid $1,650 in salaries. All right, this is going to be just like the last one. So go ahead and pause the video, try to fill out your balance sheet equation, and then come back and see if you get the same thing that I get. Okay, I quickly filled mine in. It's the same analysis as the previous. We're just paying a different kind of expense this time, paying our employees for work that they have already done for us. So our cash is going to go down. We're going to use some of our internally generated wealth that we're giving to our employees. That's an expense. It's an normal operational expense. They're going up. As expenses go up, our net incomes go down. Our net income and our retained earnings are exactly the same. And our balance sheet equation balances, our assets have reduced by $1,650, and our claims have been reduced by $1,650. Okay, let's go on to the next. CSI paid back $1,000 on a loan. Okay, so this relates to one of our previous transactions where they got the loan. So in this transaction, CSI is just paying back part of the loan principal. We're ignoring interest expense at this point. So they're just giving out some cash and reducing a loan balance, it sounds like, right? All right, so let's go back to our balance sheet equation and see what we think the impact is and the counts. All right, so here's the loan right here, and we're paying back $1,000 of that. So clearly we're going to impact our cash account. And I'm thinking since it's the principal on the loan, we're pretty clearly reducing our liability to them. So we should reduce this loan account also by the $1,000. So let's go ahead and put that in, decrease my cash by $1,000 and decrease my loan by $1,000. Okay, my assets, total assets actually decreased in this, and my claims decreased in this, both by $1,000, so we're in balance. So something interesting, these first three transactions were all asset source transactions. You can see that total assets goes up in each of these from different sources. One was from a contribution from owners, one was from a bank loan, and one we earned. So those are the three main ways a company can expand its company, other than buying other companies. But okay, the next three transactions, you'll see that these are all decreasing total assets. So these are actually called asset use transactions. They're contracting and making the size of the company smaller. Okay, nothing happening in retained earnings, and this isn't really an operational thing, so my income statement is going to stay quiet on that one. All right, let's go to our next transaction. CSI paid $500 in dividends to its stockholders. All right, in this transaction, CSI is paying cash to the owners. Payments of dividends, or these are dividends, is not an operations type activity. It's a transfer of internally generated wealth to the owners. So in other words, the company does not have to pay dividends to stay in business. So it's a little bit maybe hard to understand, but so this isn't an operations type. They're just transferring wealth. And remember, it's wealth that the company has generated. So let's go to our balance sheet equation and look at our accounts and figure out what accounts we're going to use. All right, so pretty steady pattern here. We're using our cash account again, aren't we? Okay, the question is, what claims account All right, we don't want to reduce common stock because that would be saying that we're reducing their amount of ownership, and that's not true. What we're doing is transferring earned wealth. Well, earned wealth is in retained earnings. So retained earnings is the other account I'm going to use for this. So I'm going to go ahead and I know I'm going to decrease my cash because I'm paying it out, right? And I'm going to decrease my retained earnings because I'm using up some of my generated wealth. Okay, so this, you look at it and think, oh, okay, we've got an income statement activity. And this is the one time, I promise, this is the only type of transaction that's going to hit your retained earnings where you do not impact your income statement. And it's all because of the reason I told you that this is not an operational activity. I don't have to pay dividends to stay in business. This is a transfer of wealth to owners. So it actually does not go on the income statement. It's a little hard to understand and analyze, but I promise it's the only one that's going to be like that. All right. Next transaction. All right, CSI paid $3,700 for office furniture. I'm going to assume that's cash. Doesn't say it, but we're going to assume. All right, so what's going on here? They're just really taking one asset, cash, and getting another asset, office furniture, right? So in essence, they're trading one for another. So let's take a look at our balance sheet equation and see what accounts we think we're going to impact. All right, I'm pretty sure our favorite account, cash, is going to be impacted. We're going to pay them for the furniture. And I kind of told you that we're going to get another asset. So we're going to stay on this side of our equation and see, we see here that there's an office furniture account. So I think that one is a good one to increase. All right, so let's go ahead and put our negative 3,700 cash, 3,700 increase to office furniture, and we're done. It's kind of unusual on this one because the net of those two transactions right there, that of those two accounts being impacted is 0. So total assets has been impacted 0 and total claims has been impacted by 0. So we're done. 0 equals 0. There is no income statement impact because this is not an operational wealth generating or wealth consuming activity. Okay, one last thing on this transaction is sometimes this is called an asset exchange because total assets have not changed in total amount, but we've changed the composition of what kind of assets we have. We traded some cash to get some office furniture. All righty, let's see what's next. Okay, so yeah, it's worthwhile to just take a minute and contrast and compare two common business transactions, paying for expenses versus buying assets. So we're going to review a couple of our transactions to go over this. So let's see. Let's look at right here. Okay. What's happened here? The company just paid rent, we'll say. So cash went down and retained earnings went down and expenses went up and net income went down. Okay. We're going to come to contrast that with what we just did, where they bought some office furniture. Again, cash went down, but this is a very different looking transaction. All we did was increase another asset. So why the difference between the two? Okay, some explanation on this. How do I explain this? And the difference is in paying for expenses, CSI is paying for something that's immediately consumed or already been consumed. It's paying for something that has no future value. For instance, paying your employees' salaries does not have a future value, or paying rent does not have a future value. Instead, CSI is paying employees for services that have already been rendered or consumed by CSI, or rent that for the time that they've been there. So that's why we show it being, it's a wealth consuming activity. That's why it goes through our income statement as an expense. Okay, conversely, in spending cash to buy office furniture, CSI is buying something that has future value. The office furniture can provide benefits for the company for several years. This is the definition of an asset, right? It's the stuff that the company owns or has rights to that has value. Okay, we'll discuss in future lessons how we allocate the cost of that asset as it's used up. But for now, we're just going to appreciate the difference between buying something that's consumed now and buying something that has future value. All right, so that's the end of this lesson. So go ahead and take the related quiz and then continue on to the next lesson, which should be accrued transactions.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.